You're scrolling through your investment app, looking at that $10,000 sitting in your savings account, and you're thinking, what if I could turn this into a monthly paycheck? You've heard about dividend investing, maybe seen some YouTube videos promising you can live off dividends fast, and now you're wondering if it's actually possible. Here's the thing. Most people get dividend investing completely wrong. They chase the highest yields, throw money at random dividend stocks, and wonder why their portfolio crashes 6 months later. But what if I told you there's a smarter way to do this? What if you could take that $10,000 and build a dividend portfolio that actually has the potential to generate serious monthly income? In this video, I'm going to show you the 3 best dividend stocks you can invest in right now. But more importantly, I'm going to show you exactly what happens when you put $10,000 into these companies and how long it really takes to start living off the dividends they generate. If you're interested in building real wealth through dividend investing, make sure to subscribe to the channel and hit the like button if this information helps you out. We're going to break down the math, look at real numbers, and I'll show you why these 3 stocks beat almost everything else when it comes to reliable dividend growth. Now let's talk about the elephant in the room. When people hear live off dividends fast, they're usually thinking about getting rich quick. They see a stock with a 10% dividend yield and think they've hit the lottery. But here's what most people don't understand about high-yield dividend stocks. That 10% yield? It's probably a trap. Companies don't just hand out massive dividends because they're feeling generous. When you see a dividend yield that's way higher than everything else, it usually means one of 2 things. Either the stock price has crashed because the company is in trouble, or they're paying out more money than they can actually afford. Both scenarios end the same way. The dividend gets cut and your income disappears overnight. Think about it this way. If a company is paying out 90% of its earnings as dividends, what happens when their earnings drop by 20%? They can't maintain that payout. The math doesn't work. That's why chasing high yields is like building a house on quicksand. It looks good at first, but it won't last. So what does fast actually mean when it comes to dividend investing? The average person thinks they can invest $10,000 and start collecting $500 a month within a year or 2. But the reality is different. Real dividend wealth building takes time, but it's absolutely achievable if you focus on the right metrics. The companies we're going to look at today don't offer the highest yields you'll find, but they offer something much more valuable. They offer sustainable growing dividend payments that compound over time. Instead of chasing that 10% yield that might disappear, we're focusing on companies that can pay you 3% to 5% today and increase that payment every single year for decades. So how do we actually identify the best dividend stocks? Most people just look at the dividend yield and call it a day, but that's like buying a car based only on the color. You need to look under the hood. Our first pillar is dividend sustainability. This means we're looking at companies that can actually afford to pay their dividends even when times get tough. We analyze something called the payout ratio, which shows us how much of a company's earnings are being paid out as dividends. If a company is paying out 40% of its earnings, that's sustainable. If they're paying out 95%, that's a red flag. We also look at free cash flow. This is the actual cash a company generates after paying all their bills and investing in their business. If they're generating strong free cash flow, they can maintain their dividend payments even if earnings fluctuate for a quarter or 2. The second pillar is dividend growth history. We want companies that don't just pay dividends but increase them year after year. The best dividend stocks have track records of raising their payments for 10, 20, even 50 consecutive years. This tells us 2 things. First, the company has a strong business model that generates consistent cash. Second, management is committed to rewarding shareholders. When a company increases its dividend by 5% to 10% every year, your income grows even if you never buy another share. That $300 monthly payment becomes $400, then $500, then $700 over time. That's the power of dividend growth. Our third pillar is business quality and competitive advantage. We're looking for companies that dominate their industries, have strong brand recognition, and operate in sectors that aren't going anywhere. These are businesses that can weather economic storms and continue generating profits year after year. The 3 stocks we've selected check all these boxes. They're not the flashiest names you'll hear about, but they're the kind of companies that serious dividend investors build their portfolios around. Let's start with our first pick, and this one might surprise you. We're talking about Johnson & Johnson, ticker symbol J&J. Now, I know what you're thinking. Adam, that's not exactly a hidden gem. But here's why J&J is the perfect foundation for any dividend portfolio. Johnson & Johnson has increased its dividend for 62 consecutive years. Think about that for a second. This company has raised its dividend payment every single year since 1962. That means they've increased dividends through the Vietnam War, the oil crisis of the 1970s, the dot-com crash, the 2008 financial crisis, and the COVID pandemic. When other companies were cutting dividends, J&J was raising theirs. Currently, J&J offers a dividend yield of around 2.9%. That might not sound exciting compared to some high-yield stocks, but remember what we talked about earlier. Sustainability beats flashy yields every time. With a payout ratio of just 44%, Johnson & Johnson is paying out less than half of their earnings as dividends. This gives them plenty of room to maintain payments even during tough times. But here's where it gets interesting. J&J's dividend growth rate averages about 6% annually over the past decade. That means if you invest $3,333 of your $10,000 in J&J today, you'd receive about $97 in dividends the first year. But with 6% annual growth, that payment becomes $103 the next year. Then $109, then $116 after 10 years, your annual dividend from that same investment would be around $173. What makes Johnson & Johnson so reliable? They operate in three main segments. First, there's pharmaceuticals, which includes blockbuster drugs that treat everything from cancer to autoimmune diseases. These aren't optional purchases. People need these medications regardless of what's happening in the economy. Second, they have medical devices. Think surgical equipment, contact lenses, and medical technology that hospitals can't operate without. Again, this isn't discretionary spending. Hospitals need these products to function. Third, there's consumer products. You probably have J&J products in your bathroom right now. Band-Aids, Tylenol, Johnson's Baby Shampoo, Neutrogena skincare products. These are brands people have trusted for decades, and they generate steady cash flow year after year. The beauty of J&J is that it's essentially recession-proof. When the economy tanks, people still get sick, they still need medications, and they still buy basic healthcare products. This stability is exactly what you want as the foundation of your dividend portfolio. Our second pick is Microsoft, ticker symbol MSFT. Now you might be thinking, wait, isn't Microsoft a tech stock? I thought we were focusing on dividends. But here's what most people don't realize. Microsoft has transformed into one of the most reliable dividend growth stories in the market. Microsoft currently yields about 0.7%, which honestly looks terrible at first glance. But here's why that low yield is actually a good thing. It means the stock price has been growing so fast that the yield appears low, but the actual dividend payments have been growing even faster. Over the past 10 years, Microsoft has increased its dividend by an average of 9.5% annually. That's significantly higher than inflation, higher than most dividend-focused stocks, and it's been consistent year after year. They've raised their dividend for 21 consecutive years, and there's no sign of that streak ending anytime soon. Let's talk about why Microsoft can afford to keep growing its dividends so aggressively. They've built what might be the most dominant business moat in technology. Their Azure cloud platform is growing rapidly and generates recurring revenue from businesses that can't easily switch providers. Office 365 subscriptions create predictable monthly income from millions of users worldwide. But here's the kicker. Microsoft generates absolutely massive amounts of free cash flow. We're talking about $65 billion in free cash flow annually. Their dividend payments only require about $20 billion of that cash. This means they could triple their dividend tomorrow and still have money left over for stock buybacks and business investments. If you put $3,333 of your $10,000 into Microsoft today, you'd receive about $23 in dividends the first year. That seems tiny compared to J&J, right? But with 9.5% annual dividend growth, that payment becomes $25 the next year, then $28, then $30. After 10 years, your annual dividend from that same investment would be around $56. The real magic happens when you combine Microsoft's dividend growth with its stock price appreciation. While you're collecting growing dividends, the underlying shares are also increasing in value, creating wealth from two different directions. Our third pick brings us to the energy sector with Kinder Morgan, ticker symbol KMI. Now, I know energy stocks have a reputation for being volatile and unreliable when it comes to dividends, but Kinder Morgan is different, and here's why it deserves a spot in your dividend portfolio. Kinder Morgan currently offers a dividend yield of around 6.4%. That's more than double what you'll get from J&J and nearly 10 times higher than Microsoft. But before you get too excited about that high yield, let me explain why it's actually sustainable in this case. Kinder Morgan doesn't drill for oil or gas. They don't have to worry about commodity prices crashing and destroying their business model. Instead, they operate pipelines and storage facilities. Think of them as the toll road operators of the energy industry. Whether oil costs $50 a barrel or $100 a barrel, companies still need to transport it through KMI's pipelines, and they pay the same toll fees. This business model generates incredibly stable cash flows. Energy companies sign long-term contracts, often 10 to 20 years, to use these pipelines. That means Kinder Morgan knows exactly how much money they'll make years in advance. It's like having a guaranteed rental income from properties that never need major repairs. Here's what makes KMI even more attractive. They've been steadily growing their dividend after rebuilding their financial foundation. Their current payout ratio sits at around 60%, which gives them room to maintain payments even if some contracts don't get renewed. But more importantly, they're increasing their dividend by about 3% annually, which means your income grows over time. If you invest $3,333 of your $10,000 in Kinder Morgan today, you'd receive about $213 in dividends the first year. That's significantly higher than what you'd get from J&J or Microsoft initially. With 3% annual growth, that payment becomes $209 the next year, then $226, then $233. After 10 years, your annual dividend from that investment would be around $286. The energy infrastructure that Kinder Morgan operates isn't going anywhere. Even as the world transitions to renewable energy, we'll still need natural gas for heating homes and generating electricity when the wind isn't blowing and the sun isn't shining. These pipelines represent decades of future cash flow. Now let's put it all together and see what happens when you deploy your $10,000 across these three dividend powerhouses. We're going to split the money roughly equally, putting about $3,333 into each stock. Your Johnson & Johnson position gives you $97 in first-year dividends. Microsoft contributes $23. Kinder Morgan adds $213. That's a total of $333 in dividend income during your first year, which works out to about $28 per month. Not exactly retirement money yet, but this is just the beginning. Here's where the magic of dividend growth starts to show. After 5 years, assuming each company continues their historical dividend growth rates, your annual income jumps to approximately $485. That's a 46% increase in your dividend income without buying a single additional share. After 10 years, your total annual dividend income reaches about $615. Your monthly dividend check is now over $51. But here's the really exciting part. The value of your original shares has also been growing. Based on historical performance, your $10,000 investment could be worth around $18,500 after 10 years. After 15 years, your annual dividend income climbs to roughly $890, giving you $74 per month. Your total portfolio value could reach approximately $28,000. After 20 years, you're looking at around $1,280 in annual dividends, or about $107 per month, with a total portfolio value that could exceed $42,000. The key insight here is that you're building wealth from two sources simultaneously. The dividends provide immediate income that grows every year, while the underlying stock values appreciate over time. This combination creates a compounding effect that accelerates your wealth building as the years go by. Remember, these projections assume you never invest another penny beyond that initial $10,000. If you consistently add money to these positions over time, the numbers become even more impressive. Now let's talk about what really happens to your money over time, because this is where dividend investing gets exciting. Most people think about investments in terms of what they'll make in the first year or two. But the real wealth building happens when you give compound growth time to work its magic. Here's what most people miss about dividend investing. It's not just about the money you receive as dividends. Those dividend payments are reinvesting themselves back into your portfolio, buying more shares, which generate even more dividends. It's like a snowball rolling down a hill, getting bigger and bigger as it picks up more snow. Let's run the real numbers on your $10,000 investment over 10 years. In year 1, you collect $333 in total dividends from all three stocks. If you reinvest those dividends back into the same companies, you're now buying additional shares at whatever the current price is. By year 2, you're not just earning dividends on your original $10,000 worth of shares. You're also earning dividends on those additional shares you bought with your reinvested dividends. Plus, each company is likely increasing their dividend payment, so you're getting paid more per share than you did the year before. This creates an acceleration effect. In year 3, your dividend income might jump to $425. In year 5, it could reach $560. By year 7, you're looking at around $720 in annual dividends. And by year 10, your total annual dividend income could exceed $950. But here's where it gets really interesting. The value of your shares has been growing too. Johnson & Johnson historically appreciates about 6% annually. Microsoft has averaged around 12% annual returns over the past decade. Even Kinder Morgan, despite being in the volatile energy sector, has delivered solid returns when you include dividends. If we assume conservative growth rates of 7% annually across your portfolio, your original $10,000 investment could be worth approximately $19,600 after 10 years. But remember, you've also been collecting and reinvesting dividends the entire time, which means your actual portfolio value could easily exceed $22,000. Think about what this means in practical terms. You started with $10,000 and never added another penny. After 10 years, you have over $22,000 in total value, and you're collecting nearly $1,000 per year in dividends. That's $83 per month in passive income from an investment you made once and forgot about. The beautiful thing about this approach is that it's completely passive. You don't need to time the market, pick the next hot stock, or constantly monitor your investments. These companies are doing the heavy lifting for you, generating profits and sharing them with shareholders year after year. Now let's address the big question everyone's thinking. How much money do you actually need to live off dividends? The answer depends on your lifestyle, but let's work with some realistic numbers that most people can relate to. If you want to generate $3,000 per month in dividend income, that's $36,000 per year. With our 3-stock portfolio yielding an average of about 3.3% annually, you'd need roughly $1.1 million invested to hit that target. That probably sounds like an impossible number right now, but let's break down how you actually get there. The mistake most people make is thinking they need to save up $1.1 million and then start investing. But that's not how wealth building works. The key is to start with whatever you have and consistently add money over time while letting compound growth do the heavy lifting. Let's say you start with your $10,000 and then add $500 per month to your dividend portfolio. That's $6,000 per year in additional investments. After 20 years, you'll have contributed $130,000 of your own money. But with dividend growth and reinvestment, your portfolio could be worth over $400,000. If you can increase your monthly contributions to $1,000, the numbers get really exciting. After 20 years of investing $1,000 monthly plus your initial $10,000, you'll have contributed $250,000, but your portfolio could be worth over $750,000, generating around $25,000 per year in dividends. Here's the part that blows most people's minds. In the early years, your contributions matter more than investment returns. But as your portfolio grows, the investment returns start to matter more than your contributions. There comes a point where your investments are making more money each year than you're adding to the account. For example, if you have a $500,000 dividend portfolio growing at 8% annually, that's $40,000 in growth per year. Even if you're only contributing $12,000 annually, the investment growth is doing most of the work. This is when you know you're on the path to financial independence. The timeline to reach $3,000 monthly in dividend income depends on how much you can invest each month. With $500 monthly contributions, you're looking at roughly 25 to 30 years. With $1,000 monthly contributions, you could hit that target in 20 to 25 years. With $1,500 monthly, you might get there in 18 to 20 years. But here's what makes this approach so powerful. You don't have to wait 20 years to see benefits. Your dividend income is growing every single year. After 5 years, you might be collecting $200 per month. After 10 years, maybe $500 per month. After 15 years, you could be getting $1,200 per month. Each milestone makes your life a little bit easier and gives you more financial flexibility. The key is to start now, even if you can only invest small amounts. Time is your most valuable asset when it comes to compound growth, and every year you wait is a year of potential growth you're giving up. Can you live off dividends fast with just $10,000? The honest answer is no, not immediately. But you can make $10,000 a month in dividends if you watch this next video.